Right now, somewhere in the world, someone is panic buying silver, not small amounts, not cautious purchases, massive quantities, because they know something you don't. They know the warehouse doors are about to close forever, and they're buying before that happens. I found the trail they left behind. The data is undeniable. By the end of this video, you'll see exactly why they're panicking and why you should be paying attention. Silver broke above $50 for the first time in 50 years. Think about that specific statement. 50 years, half a century. From 1980 to 2025, silver remained trapped within a narrow range between $4 and $50. Every single time it approached that $50 level, it experienced rejection. 1980, rejected. 2011, rejected. The financial world accepted this as normal reality. Silver is simply a $50 metal. That became the narrative repeated throughout your entire life. But here exists something critical nobody discussed. During those identical 50 years, gold did not stay trapped. Gold exceeded its 1980 high. Gold surpassed its 2011 high. Gold continuously made new highs decade after decade. Copper followed identical patterns. Copper remained compressed between 50 cents and $150 for decades. Then 2006 brought a breakout, reaching $450. Lead experienced the same movement in 2007. Every major commodity compressed in long-term ranges eventually broke through, experiencing dramatic repricing. Every single commodity except silver. For 5 decades, silver was the sole major commodity held artificially below its historical range. This means something profound. The compression accumulated over 5 decades is now releasing. When 50 years of suppressed energy breaks free, markets do not move 10%. They move hundreds of percent. This represents not opinion, but chart reality. I studied every major silver surge in modern history. The pattern consistency astonished me. From 1979 to 1980, silver moved from approximately $12 to $50. That represents quadrupling. This occurred within 5 months, not 5 years, 5 months. From 2010 to 2011, silver moved from approximately $18 to nearly $50. That doubled in 7 months. Both surges happened within quarter time frames. The explosive portion where real money gets made happens fast, within months, not years. Both surges included sharp corrections producing gut-wrenching pullbacks. Everyone declared silver finished. Both times that pullback represented the final positioning opportunity before acceleration commenced. Now examine recent events. Silver accelerated starting November 2025. December represented month 2. By January end, silver surged above $90. Then came the crash. A brutal collapse within day and a half returned silver downward, sickening every holder. This matches the pattern precisely. Month 1, month 2, sharp correction, weak hand elimination. If the pattern maintains, which it has twice before with remarkable precision, the real move has not started. The majority gain, where silver moves from current levels to 300 or beyond, happens months 3 through 6. This timeline suggests early summer 2026, but here emerges critical distinction. In 1980, silver quadrupled inside a $50 ceiling. The 4 to 50 range contained the surge. In 2011, identical constraints applied. Silver doubled but hit that $50 wall. Both surges were powerful but confined within old reality. This time, silver has already broken through the 50-year ceiling. The old reality has vanished. The $50 cap held for half a century, but shattered. After the brutal crash, silver did not fall below 50. It held above the old range. The floor of the new reality is the ceiling of the old one. Silver is not returning to the old world. It is building a launch pad above it. Consider the dam analogy. For 50 years, water accumulated behind concrete walls. Pressure increased yearly, decade after decade. Every breach attempt faced resistance, but water never disappeared. Pressure kept building. Now the wall cracks. Water will not trickle politely through. It blasts through with 50 years accumulated force. That describes silver's current situation. The dam cracked. Nobody can repair it. Most silver analysts commit critical errors, costing audiences fortunes. After the crash, prominent precious metals voices announced selling entire positions at $90. They referenced RSI charts, momentum oscillators, overbought indicators declaring silver overextended, technically correct regarding corrections. But here exists the fundamental problem. They employ old tools measuring new reality. Using thermometers designed for room temperature on volcanoes does not work. The instrument was not built for this scenario. RSI hitting 80 on monthly charts used to mean overbought when silver was trapped between 4 and 50. Those readings made sense then. Currently, we operate outside that range. Annual momentum charts demonstrate silver already exceeded momentum levels, marking 2011 highs and 2020 surge highs. The old momentum ceiling broke like the price ceiling. Anyone using old overbought metrics times their exits, missing the largest move of their lifetimes. Once sellers exit, psychological barriers against higher price reentry become enormous. Most never return. They watch from sidelines while silver replicates copper's multi-decade breakout trajectory. They were right about correction, but catastrophically wrong about trend. Three types watch this content. First type sold during crashes, hoping I am wrong, validating their decision. Second type held through pain-seeking confirmation. Third type watched sidelines, awaiting perfect entry, realizing perfect entry may have passed. Data ignores feelings. Data only cares about patterns. Patterns indicate we are in month 2 of 5 to 7 month surges, historically producing triple-digit percentage gains. Shanghai silver prices compared to New York COMEX prices reveal $30 gaps. Shanghai silver trades $30 per ounce above Western prices. That is not rounding error. That is not temporary glitch. That is physical markets declaring paper prices fictional. The gap is real and widening. China implemented export controls January 1st, 2026. Only 44 state-approved companies export. 60 to 70% global refined silver supply is trapped inside Chinese borders. The result is $30 Shanghai premiums. But China is not alone. Bullion dealers across North America report scenarios where clients may receive $10 to $15 below spot on physical deliveries. Dealers cannot obtain sufficient physical silver fulfilling orders at market pricing. They warn clients beforehand. This is not healthy market function. This represents markets where screen prices and real-world prices diverge completely. Historical evidence demonstrates physical premium widening always results in paper price adjustments upward, never downward. The paper price rises toward physical reality. This never worked inversely. When COMEX shows current quotes, understand actual metal changing hands in world's largest consuming nation trades $30 higher. That gap must close through Western price increases. Silver rides two critical waves. Most consider silver industrial metal only, partially correct. Silver enters solar panels, artificial intelligence infrastructure, electronics, medical devices. China produces 80 to 90% world solar cells with silver essential throughout. Global supply deficits persist for 5 consecutive years. Demand exceeded supply yearly since 2021. Industrial silver incorporated into solar panels or circuit boards becomes permanently lost. Amounts prove too small, economically recycling. Every ounce industrially used represents permanent supply removal. That constitutes wave 1. Wave 2 changes everything. Silver is money. Silver has served monetary functions for 3,000 years, not 300, 3,000. Currently, extraordinary developments occur. India's Reserve Bank issued regulations allowing silver formal bank collateral effective April 1st, 2026. This represents first major economy silver monetization since 1800s. 1.4 billion people gain access to silver as recognized monetary assets. This is regulatory fact, not speculation. When silver acts exclusively as industrial metal, factories and supply chains drive pricing predictably and manageable. When silver functions as money, when 1.4 billion people treat it as value storage, demand curves become vertical. Gold rides monetary waves for years, explaining continuous highs. Gold represents monetary system's mother metal. Silver is gold's younger sibling. For 3,000 years, silver followed gold with temporal lags. Currently, lags reach historically widest levels. Silver trades absurdly cheap relative gold. Gold to silver ratios remain near historically extreme levels. Every time this ratio stretched this far, silver violently repriced closing gaps. Not slowly, but violently. Two massive demand waves converge simultaneously. Industrial demand overwhelming supply for 5 years. Monetary demand unlocking for 1.4 billion people. Both waves hit concurrently. Supply side shrinks because China locked 60 to 70% refined silver inside borders. This is not set up for 10% moves. This is paradigm shift setup. Connecting broader financial landscape context matters. Silver does not exist vacuums. US dollar index reviewed from 2010 shows long-term momentum, broken, not bending. Broken. Dollar slipped below structural support, maintaining over decade. Dollar does not collapse overnight, but exhibits slow decay. M2 money supply data shows every decade supplies increase 80 to 90%. This is Federal Reserve data, not conspiracy. Every decade, they print 80 to 90% additional dollars. This means purchasing power drops decade after decade. Precious metals mirror this decay exactly. Structural dollar weakening produces gold and silver appreciation, not merely nominal. They reprice, reflecting cumulative purchasing power losses masked during strong dollar periods. That repricing happens currently. Additional factors concern me positively for silver and negatively for broader economy. Government bond markets crack. U.S. Treasury futures trade around 115. Recent lows touched 113 range. Here lies critical line. Bonds dropping 3 more points, entering 112 range breaks, holding patterns maintaining bond price stability since 2022 collapse. When that breaks, U.S. bond markets mirror Japan. Japan operates crisis mode already. UK bond markets experience stress. Global government debt reaches levels making conservative investors nervous. Jamie Dimon stated months prior that pushing down roads cannot continue indefinitely. When average citizens previously feeling safe depositing government bonds start doubting that safety, this represents financial system nuclear events. If government bonds cannot be trusted, where does money go? For 3,000 years, gold and silver answer that question. That answer returns. Commodity complexes break out. Bloomberg Commodity Index broke above massive long-term momentum bases. Crude oil triggered breakouts ending 2-year energy price depressions. Crude moving $60 to $90 represents 50% jumps in gasoline prices, despite $90 not being historically expensive when we reached $130 in 2022. Wheat joined breakouts too. Commodity price surges squeeze average consumers, cost of living increases, inflation expectations rise. Monetary metals become logical shelter. Stock market investors face uncomfortable realities. S&P 500 compared to gold and silver over last 4 to 5 months shows sideways movement banging against 7,000 going nowhere. Gold and silver, even after pullbacks, dramatically outperform stocks. Massive asset class rotations occur. Money quietly moves from paper financial assets into hard assets, commodities, energy, precious metals. Dollar breaking down, bonds cracking, commodities breaking out, stocks sideways, physical silver premiums at $30, industrial deficits 5 years running, India remonetizing silver, China locking supply, vaults draining across continents. I studied markets extensively, never seeing convergent signals of this magnitude on single assets. This is not one factor suggesting higher silver. Every major macro indicator points same direction simultaneously. Gold made cycle lows in 2015 around $1,050 per ounce. Previous bull markets produced eightfold moves from cycle lows to peaks. 1980 peak represents eightfold moves from bases. 2011 peak represents eightfold moves from bases. Eightfold moves from 150 puts gold at $8,400. JP Morgan published $8,500 gold targets. One planet's largest banks publishing same target. That patterns produce independently is not coincidence. That is confirmation. This means something critical for silver. If gold reaches 8,500 and gold to silver ratios revert halfway toward historical averages, $300 silver is not aggressive. It is mathematical midpoint. $500 silver becomes full normalization upper ranges. Remember, explosive moves based on 1979 and 2010 precedents happen within 5 to 7 months from initial breakouts. We are in month 2 now. I must address risks honestly. Silver is volatile. $90 crashes prove that. Leverage using traders get wiped out on pullbacks despite long-term upward directions. Mining stocks drop 50% corrections even during bull markets. Timing is brutal. Nobody gets it perfect. Pattern break scenarios exist. Governments aggressively raising rates, deflationary shocks, China reversing export controls weaken thesis. I do not consider these likely based on current data, but possibilities exist. February represents stabilization months. Arm wrestling matches, silver bounces, pulls back, bounces again. It feels frustrating. It feels like nothing happens. But underneath, structures rebuild. 3-month moving averages hold. Short-term buy signals trigger. If silver reclaims upper $80 this week or next, bears face serious troubles. By March, if patterns hold, silver challenges recent highs again. That is when games change because second time silver approaches highs after shaking weak hands, overhead resistance vanishes. Everyone selling has already sold, only buyers remain. That is acceleration moment, March through June. That is the window. That is where 1979 produced quadrupling. That is where 2010 produced 2.5 times movements. This time, starting points are not $12 or $18. Starting points are highest basis silver ever launched from above 50-year ceilings. Every macro indicator aligned, physical premiums screaming real prices already much higher than screen shows. 5 years hence, you will look back. You will remember $90 crashes. You will remember feelings, doubt, sick stomach sensations, headlines declaring silver finished. You will remember this as moment you panicked selling or moment you examined data, saw patterns, made life-changing decisions. Silver trapped 50 years, 50 years compression, 50 years told it could not break 50. It broke, it shattered, it has not returned. Even worse crashes in years, silver stays above old ranges. The floor of new reality is the ceiling of old reality. This is pattern, this is mathematics, this is exactly what charts demand.